As a bond investor, the single biggest predictor of your future returns is the level at which you buy yields.
Something that I'm most concerned about, which is our deficits and the debt and the rising debt.
The third is you sort of surreptitiously deflate the debt by keeping inflation running at a little bit higher levels than your policy rates.
Hello, everyone. My name is Philip Palumbo. I am the host of the Palumbo podcast, where we interview some of the most successful founders of businesses, as well as successful market strategists, portfolio managers, and economists. Today, we have with us Lisa Hornby, who has 20 years experience in the fixed income space at Schroders, starting a career at Barclays as an analyst in the credit markets. She currently is head of U.S. fixed income, overseeing close to $40 billion. Schroders is a leading provider of asset management, managing over $1 trillion in assets and operating in 38 countries around the world. Lisa, thank you for your time today. I really appreciate it.
Thanks, Phil. Thanks for having me.
All right. So a lot of stuff going on in the fixed income space, right? I want to first talk about yields. One of the things that I personally had thought when Trump won back in November, my biggest concern is the long end going above 5 and maybe even the 10-year. So in other words, I thought maybe interest rates go up because there'd be more deficit spending, debt would increase, which by the way, it hasn't been fixed. But really since then, we've seen yields come down. So what is your view of why you think yields have gone down?
So you weren't completely wrong, though, because the curve did steepen. So while yields have come down, we saw the back end come down more than the front end, right? And so what's driving that? I mean, a big element of what's driving that is monetary policy. So the Fed obviously met this week. They lowered interest rates. They started their cutting of the interest rate cycle really a year ago. They paused for a period of time, and now they've restarted that program. And so I think you have the Federal Reserve or monetary policy really sort of anchoring yields by pulling the front end down. And the market has the expectation that there will be a number of interest rate cuts over the coming year. And so that's sort of capping the entire curve. And I think the other part of that is that the long end, to some degree, some of the concerns about the long end have been remediated. So yes, the deficit spending is a big problem, but we do have some tariff revenue that was a bit unexpected that is coming in to offset some of that. So, tariff revenue on the order of 30 billion a month is a bit of an offset to some of the deficit problems that perhaps were passed during the One Big Beautiful Bill legislation. I think the other element is that you have an administration that is acutely focused on managing the overall level of yields. So yes, they want the front end rates lower. They want the part the Fed can control to be lower, but they are also quite focused on keeping the back end anchored. And so you've seen them talk about perhaps doing an emergency housing act. Now, we don't know what that will look like, but the idea here is that the housing market has frozen up. Many people, 75% or so of Americans, have fixed rate mortgages below 4%. And so there is just not a lot of turnover in the housing market because people are reticent to move out of their 4% mortgage and into a 6% mortgage. So they're very focused on how do we manage the overall yield curve. And so I think some of their rhetoric, potentially how they're going to structure issuance going forward, reducing long end issuance and instead issuing at the front end. I think that's also keeping a cap on yields. And I think the market has attuned to that more recently because we have started to see that steepening reverse a little bit.
One of the things I thought in my head, Lisa, was when Trump was elected is he's a real estate guy and he's going to do all he can to bring yields down. So as much as I anticipated yields to rise, I also thought in the back of my mind, like he's going to do all he can to bring rates down. And like what you just said, they're really pushing for that. And the reality is the housing market really has been terrible over the past 2-3 years, right? There's been no turnover there, there's no inventory out there. And real estate prices have stayed exactly the same, if not gone up, actually. So, one of the big ways to really help that, obviously, is to bring yields down to levels where we can start to get some action in the home real estate market. Do you really believe that's going to happen, though?
Do I believe yields will continue to come down? Is that the question?
Yes.
So on a short-term basis, I think we've had quite a big move in interest rates down. The long end has rallied 25 basis points or so. That's quite a lot in DV01 or duration dollar terms. I think the 10-year is probably closer to the bottom end of the range. I mean, we're looking at a 4.13% 10-year. my tactical bias is that rates could actually sell off a little bit here from here, so move a little bit higher. But long term, I do think rates are sort of capped within a fairly defined range. You have the Fed is on a fairly well-defined path. They've telegraphed it to us. They're going to cut rates. Is it going to be two cuts for the balance of the year? Is it going to be three cuts? It's almost irrelevant. They're going to cut for a period of time. We'll see how the economy fares. I mean, what seems apparent is that the labor market is slowing. But I don't think growth is that bad. I think growth is actually fairly resilient in this kind of 2.5% range, which means, the Fed's not going to be cutting rates forever, unless we get some sort of tail risk or shock to the economy. So I kind of think, rates 10 years around 4% seems reasonable. I would be trading outside of a kind of 4.3% range. I would be taking the other side of that. I think we're in a pretty defined and narrow range right now because the economic outcome seems like it's somewhat predictable. The labor market will probably continue to slow for a period. Inflation is contained. It doesn't feel like a problem to me. The economic backdrop is okay. So, the Fed is currently focused on that employment side of their mandate, which means like their path will be somewhat predictable, at least for the coming months.
Mhm. So you went through your prediction, where you think rates will go, et cetera. So regarding timing of interest rates, just like timing of the stock market, and I get this all
Mhm.
the time from clients. Sometimes people think, "Oh, Phil, he's managing my money. It's his job to figure out where the market's going." And no,
Mhm.
a long-term investor, it's impossible to time the market. Is my personal view. Doing this 25 years, it really, really is very, very difficult. Do you feel the same way about interest rates?
Um, yes and no. So I think there's probably some tactical biases that you can trade around. Right now, again, the range feels fairly defined. Um, I think the overwhelming answer to your question is that structurally, we are at a very attractive level of interest rates and fixed income. I mean, if you look back over the last 20 years, yes, yields have come down a little bit recently, but we're in the kind of 80% of the time. We are in the period where rates are higher today than they have been 80% of the time over the last 15 or 20 years. And so that means we have a very constructive backdrop for fixed income and fixed income returns. And I think as a bond investor, the single biggest predictor of your future returns is the level at which you buy yields, right? So if you're entering at a 5% all in kind of investment grade credit level, then your future returns will be something on the order of 5%, because that's your starting point. And yes, could there be some capital appreciation depending on your time horizon? Absolutely. But generally speaking, that's the biggest predictor of your total return experience. And so if you're buying yields at a very high or elevated level, you should be able to project pretty decent total returns. So that's kind of my starting point for fixed income today. And this argument was a little bit more robust 6 months ago. Yields were a little bit higher, and so we could have made this case even stronger. But even now, if you look back compared to where we were, a few years back, I mean, we had a 1% tenure. Now we have a 4% tenure.
Right.
So the environment for fixed income looks pretty good. On the other side of the equation, you look at equities and PE multiples. We reach all-time highs every single day. That's great if you are in the market, for sure, but that does mean that at some point there's some downside risk to that, right? We do have corrections. These things happen, especially when as markets become more ebullient and more excited about the backdrop. Some crazy things tend to happen. New structures are created, more risk taking happens, and so that's where that dynamic does tend to end in a one where there's a little bit more caution because of necessity. And so I would say fixed income today looks pretty good. I'm a little bit more cautious on some of the other sectors out there, maybe not tactically, but over a slightly longer term basis.
Right. So going back to what you said before, so if I'm allocating 25% of my money to fixed income based on today and 80% number that you just threw out before in terms of where yields are relative to the past 15, 20 years, then what you're basically saying, if I can buy a 10-year today at 411,
Yeah.
414, whatever, that pretty much over the next 10, 15 years, I mean, I'm pretty much going to be at that number unless rates obviously go a lot lower and I refinance at a lower level when that debt comes due. That's pretty much what you're saying with that tranche of money.
Right. Well, definitionally, if you buy a 10-year and you hold it for 10 years, you will earn 4.14% a year. But I suppose what I'm trying to say is if your holding period is shorter, you still have a 4% yield that you are accruing every year, which means that you have some cushion should there be an adverse rate shock. In other words, if rates go up and your capital falls, you still have a 4% coupon that you're accruing every single year. On the other side of the equation, the more likely scenario is that rates do fall a little bit, just as the Fed continues to cut. Perhaps the economy goes through a little bit of a softer patch. In that case, you have capital appreciation to add to your 4% coupon.
Yep.
So give or take, I think a 4% sort of total return outcome is where you'll be over some relatively long holding period, let's call it 1 to 3 years.
Mm-hmm. So Lisa, when you think about portfolio management, right, which is what I do for a lot of my clients, where I'm trying to diversify their approach to investing their capital, and we think about, okay, if we're investing in fixed income today and we're talking about on the treasury side, right? We'll get into some credit in a moment, but on the treasury side, if you're at that 4.5%, right, that's pre-tax
Mm-hmm.
and pre-inflation.
Yep.
So for those that may be in a higher tax bracket, when you factor in taxes and inflation, your return with that 4%, 4.5%, seldom can be like +1, 0, -1, depending.
Mm-hmm.
Do you think about that as a fixed income manager, or more just how can I just, just it's a different type of risk reward scenario as an investor?
Yeah. So absolutely, it's a great point. So I'll address. So first of all, we think about something called real yields. So real yields are nominal yields net of inflation. And real yields, so 10-year real yields are just under 2%. That is actually historically a high level as well. So your real yield, what you earn after inflation, 2%, it may not sound like an amazing, it's certainly not shooting the lights out for anybody, but it is way more positive than you have been able to obtain most of the last 20-year period. At one point, real yields were, I'm just going to, rather than quote, I'm just going to pull up the chart here for a second on Bloomberg. Real yields have been at several points over the last, actually even 5 years. That's what I was checking. In 2021, real yields were -1%. So 10-year real yields. So I just wanted to make sure it was only 4 years back. So in the last 5-year period, you had a swing from -1 to +2. So that's a pretty material move. So that's one point. Real yields, so net of inflation yields, are actually high. And the second point is, as a tax-aware investor, so many of my clients are tax-paying, U.S. tax-paying clients, one of the best opportunities in the markets that we're seeing right now are actually tax-exempt municipal bonds. So the tax-exempt muni market has had a pretty significant dislocation this year. I mean, earlier, there's lots of ways to look at tax-exempt munis, but one of the more common ways is to think about the ratio of tax-exempt municipal yields to treasury yields. So exactly to your point. And typically on kind of a longer term basis, you should earn about 90% of the yield of a treasury in a tax-exempt bond. So that makes sense. You earn less yield in a tax-exempt because you're not paying taxes on that income. This year, that ratio moved up at one point as high as 102, 103%. So you are actually being paid to take the tax exemption for free, which is a pretty unusual.
Can you give us a math example of that for those that are listening, because they may not?
Yeah, so let's just say, so a 30-year treasury right now, let's just use easy numbers. So the 30-year earlier this year was around 5%.
Yeah.
So typically you would expect a tax-exempt municipal bond to trade around 90% of that yield, so 4.5%. But instead of trading around 4.5%, earlier this year, we saw the ratio move to about 102. So that means you were buying a 30-year tax-exempt municipal bond at a yield of, let's call it 5.1, 5.15%.
Which is phenomenal, because that 5.1% is not taxed federally.
It is tax-free income, federally tax-free income.
Versus treasuries, the 30-year treasuries taxed federally.
Correct. So instead of paying, if you're in the highest marginal tax rate and you're paying 40% in taxes, you are paying none of that 40% in taxes in your tax-exempt municipal bond. And, as an investor, we call ourselves kind of crossover. So most of my client base is not tax paying. So it's institutional pension funds, things like that. They don't have tax considerations. typically we don't own tax exempt munis in those types of strategies because we'd be dropping yield. They don't have to pay taxes, so it doesn't make sense to do that. This year, that opportunity became so robust that we actually started buying tax exempt munis in our non-tax paying strategies.
Wow.
So a very unusual situation, but one where we feel the opportunity is great. Now it has started to correct a little bit. We're seeing those ratios closer to 90% again, but we actually think that they'll break through that to the downside because we're starting to see quite a lot of flow come into the municipal bond market.
Yep. Yep. Super interesting. So getting back to what I said before, so if you're speaking to, so institutional investors are much different than retail investors, right? Because institutional investors, they need that 4, 5, 6% coupon for cash flow purposes, whatever you're managing to. So for the retail investor, if they say to you, Lisa, that real yields today are 2%, and that's before I pay taxes, and I'm retired, I have $30 million, and if I park part of my money, 25% or 50% in fixed income investments, my real yield is 2 before taxes, and the taxes at 0, what do you say to them?
So I would be looking this year at the tax exempt municipal bond market for exactly those reasons, right? So if you were to take that, I mentioned we were buying at yields of north of 5. So if you're taking, let's just use 5 to make it easy math. If you are in the highest marginal tax rate and you are earning 5% tax-free income, that is the equivalent of something like an 8% taxable yield.
Right.
Now, I would look at that versus the other options in the taxable bond market. Okay, so everything except for munis effectively is taxable. So to find an 8% yield, you would have to be moving into, I guess, the maybe single B, probably triple C rated portion of the high yield market. So you would have to be moving quite low in quality. I don't even think single Bs would get you that right now. I can't find the screen that I need.
I don't think you will,
Yeah.
right?
So you'd be buying definitionally very low rated companies that have very uncertain cash flow profiles, potentially refinancing risk. So that's kind of where your optionality is at the moment, right? If you need that yield, you can either go to the taxable market and buy kind of triple Cs, or you can buy 5% tax exempt, which is the equivalent of 8%, and have that income. Now, look, inflation is something everybody faces. But if our view, inflation is probably anchored around 2.5%. So if you have 5% tax free, you'll drop about 2.5% of that due to inflation. So then your real return, your real net of inflation is 2.5%. It's not, equities this year have done, 10, 11%, depending on what part of the market you're in. But that also has to be inflation adjusted. And clearly you're taking much more risk in an equity than you are in a government, effectively a government debt, because that's what a municipality is.
Yeah, so I want to stay on this subject because this is really important because there's some clients that say, hey, I want better returns, I want more returns, but I know they can't handle the risk of increasing more equity exposure because that's really how you're going to get better returns.
Yep.
So then they say, well, there has to be another solution out there, right? And what I'm trying to explain to them is that everything is based on the risk-free rate. The risk-free rate is the 10-year yield or the treasury bill, however you want to look at it. But typically when it comes to a discounted cash flow analysis, you're usually using a 10-year, right? So you can buy a 10-year treasury, get 4.14 with no risk. In other words, the risk of the government going bankrupt and you not getting paid or getting your principal back is very, very low. Can it happen? Yes. So now, like you just said before, if you want to really ramp up risk, you got to look in the part of the market that is extremely, we call it junk bonds, right? And even when you start to enter the junk bond space, you're not going to get 8, right? Unless you really, really are taking on something of very, very low quality, which means now you're back to equity risk.
Mm-hmm.
So can you?
Yeah, I think that's precise. I mean, and we're in that situation with investors too, right? Everybody, including myself, we want the answer, the highest returning asset with the lowest level of risk at all times. And unfortunately, there's no magic. There's kind of no magic beans in this business. Like the higher the yield that you're obtaining, then you're sacrificing something. You're actually either sacrificing the sustainability of cash flows, the certainty of cash flows, the liquidity profile. And so it's kind of a give and take, right? What are you willing to give up in order to obtain that higher level of yield?
Right, right, exactly, exactly. And so it's like, so when you construct an active portfolio for a client and you sit across the table for them, and especially when you start working with them, you sense their emotions when markets go down. And if they're extremely emotional when markets go down, you can't have 100% in stocks. And then you got to say, well, based on your world, Lisa, well, what percentage of my money should be in fixed income to counterbalance stocks when they go down a lot? And that's what diversification is all about. And you can't have your cake and eat it too. You can't say, hey, I want better returns because things are going great. And then when things go bad, you get emotional. You just can't have your cake and eat it too. And you said it perfectly before. I want to talk about inflation. So there's obviously, and I've personally been saying the entire time, I don't believe there will be inflation issues. Maybe it'll be a one-time jump, or maybe slowly things will creep up. I don't think we're going to go back to 3 years ago when inflation CPI went to 8, 9%. Um, but bond investors are a lot smarter than stock investors. We all know that, right? So
If you said it.
And that's my personal view. I've been doing this for a long time. And so, in terms of inflation, why do you believe inflation will be tamed?
So there's a few reasons. So first of all, if you look at the composition of the CPI basket, about 40% of it is rent or home, the amount you pay to stay in your home. And so what we're seeing is that portion of the basket is fairly anchored in the kind of 3% range. And actually at the margin, it's starting to come down a bit. And we can verify that by looking at higher frequency indicators like Zillow has a rental estimate, and we're seeing kind of all the high frequency estimates suggest that rent or the price of housing, which by the way I understand is not a perfect proxy, but it does make up CPI. That is fairly anchored in this kind of 3% range. So you have the biggest single portion, 40% or so, stable around 3. Then you have some of the other more service-oriented sectors. There's a little bit, there's been a little bit of inflation there over the last few years. Obviously, you alluded to it, but we don't see much additional pressure coming through. And that would be supported by the fact that we are seeing softening in the labor market. So when there's softening in the labor market, service providers are not able to increase prices at the same frequency or pace. And so we feel fairly confident that I would say it's another 30% or so of that CPI basket is also fairly contained in terms of where it could go. And then the last part is goods. And goods, historically was running in a deflationary, so actually negative inflationary trend. That changed with COVID for a period of time. Then we kind of leveled off again. Our view on the good side of things, will there be a little bit of tariff related noise? Yes, possibly. But there's a lot of ways for companies to offset that tariff related pressure. First of all, companies at the moment are actually eating some of that in margins. So, margins are at effectively all-time highs. So there's a little bit that's being absorbed by margins. Larger companies are also able to push on their own suppliers. So they're able to kind of push some of those costs. Consumers are also able to change their behavior, right? If they start to see the goods that they want move up in price, they're able to shift potentially to a different good, maybe not buy that good at all. So, with all of those things kind of considered, when we look at inflation, we kind of see it in this sort of 2.5% range. Could we have 25 basis points higher or lower, give or take, in a coming quarter? Absolutely. But that feels like a fairly reasonable proxy for where we'll be.
Totally agree. So I want to close this out with talking about something that I'm most concerned about, which is our deficits and the debt and the rising debt.
Yeah.
And that's the one reason why I say all the time, like, why I really believe diversification is so important. As great as things are going with AI, as great as I believe the current pro-business policies that will help kind of move the economy going forward, all of that sounds great. But really, on my shoulder is this like screaming person saying deficits and debt don't get crazy in terms of risk, right? I wish we could just remove that, but we can't, and it's only gotten worse over the years. And I believe now debt to GDP, deficits to GDP are now greater than post World War II or right at World War II. So, so what is your view about that? Number one, and number two, how do you believe it can or can't be fixed?
Okay, so views on the deficit, it's absolutely a problem. It's been reflected this year in the curve steepening, as we talked about. It probably, curves probably stay steeper for the next few years as a result of this kind of constant give and take by the market. Sometimes the market's going to care more about this deficit issue, and sometimes it's going to care less. We were in a period of time, clearly for three or 4 months this year, where the debt and the deficit was a big problem. And it's actually, by the way, it's not just a US problem. Curves have steepened globally across every sovereign, effectively every at least developed sovereign nation. We've seen the same phenomenon. So the market has cared quite a lot about it. I think that this administration in particular is sort of focused on it. Bessent went through the whole 3-3-3. One of the threes was that they want 3% deficit. So we're clearly not there yet, but perhaps that's something they're going to try and move towards. So I do think all else equal, curves remain steeper than they otherwise would. Okay, so that's number one. Number two is I do think the currency feels some pressure. Now, part of the problem is if every country is going through the same phenomenon, well, how do from a currency perspective, if everybody has the same problem, it's hard to see differentiation in the currency. But I do think as certain countries perhaps work through it, they may see some benefits. The US might see some problems if we stay on this path. And then in terms of the second part of your question, which is how do we address it? There's only a few ways to deal with deficit spending. So one is the politically unpopular one, which is you actually cut spending. So that feels fairly unlikely. Two is you default, which feels also fairly unlikely in the US situation. And the third is you sort of surreptitiously deflate the debt by keeping inflation running at a little bit higher levels than your policy rates, your Federal Reserve set interest rates. And what that does is it ensures that revenues are coming in at a slightly higher level than your fixed interest expense that's going out at. And that over time kind of collapses your debt problem. Now it takes quite a long time, but what will happen is that eventually people will see, well, actually the debt problem is shrinking, and that gives comfort to the market. I think the third option is the most likely one. And that's part of why we think the inflation rate will be probably closer to 2.5% than what it was pre-COVID, which was 1.5%. We think the central bank will be incentivized to keep rates pegged a little bit lower than they would if there was no debt problem. Of course, they can't say this, but we think that that's probably implicit in their strategy. They want to keep rates lower than the economy would justify because that kind of keeps things cranking. And the last thing I would say, which actually this is something that we've just really started to think about more in the last 6 to 12 months, is if you do get productivity gains out of AI and all of the spending that's happening, you could actually make a meaningful dent in your deficit or your debt problem by increasing potential growth rates by a very small amount. If nominal growth goes from, let's say structurally it's 2 to 2.5 or 3, because of productivity enhancements, and we don't spend the gains, that actually goes a long way into curing your debt problem. So I suppose maybe the fourth element is that you can increase revenues, right? So I said you could cut spending, which is unpopular, but actually you could increase revenues. And I think AI is one way that you increase the overall pie. And I guess the other part of that is tariffs are revenue raising. And so it's funny, obviously they were quite unpopular with many people initially, but I actually think no matter what administration comes in the coming years, I think they're going to keep tariffs on because actually they generate quite a bit of money. We need that.
Absolutely, absolutely. So Lisa, this was absolutely phenomenal. You're extremely intelligent in what you do, and your perspective is amazing. So thank you so much for your time today. I really, really appreciate it.
Yeah, thanks, Bill. This is great. It's fun to talk about these things.
Enjoy your weekend, and we'll stay in touch.
Thank you so much.